What guides auditors' decisions in the real world? Auditing standards and ethical principles play a crucial role. Imagine navigating complex financial landscapes armed with these ethical compasses. They not only set benchmarks but also instill integrity in every audit step. As auditors, how do we balance these standards with real-world challenges? Let's delve into the intricate dance of principles and practicalities, where decisions aren't just black and white but painted in shades of gray. Consider this: in auditing, standards aren't just rules but beacons guiding us through murky waters. Join us as we explore how these standards and ethics shape audit decisions, ensuring trust and transparency in every financial examination. Welcome to our course overview. Today, we dive into the essential components of auditing. First up, we unravel the standards on auditing, the backbone guiding audit practices. Next, we explore the critical independence requirements, emphasizing the necessity for auditors to uphold objectivity. Then, we delve into auditor rotation rules, shedding light on the importance of changing audit partners and firms. Moving forward, we focus on the vital aspect of confidentiality, ensuring the safeguarding of client information. Lastly, we tackle the complex realm of professional judgment, where ethical decisions in challenging scenarios take center stage. As we journey through these key topics, we aim to equip you with a comprehensive understanding of the audit landscape. Remember, in auditing, precision and integrity are paramount. In the world of auditing, standards on auditing, SAs, serve as the essential rulebook for auditors, outlining the guidelines and rules they must adhere to during audits. These authoritative pronouncements, set by professional accounting bodies, ensure consistency, quality, and reliability across all audit processes. For public companies in the U.S., the PAB establishes audit standards, while the ACPAS-ASB does the same for private company audits. By upholding these standards, auditors safeguard investors and the public interest. Why do standards matter in auditing? They bring consistency, ensuring all auditors follow the same procedures for comparable audits. Standards also uphold quality control by setting minimum requirements, guaranteeing thorough and reliable work. Moreover, adherence to standards offers legal protection, shielding auditors from liability and demonstrating due professional care. Ultimately, these standards foster public trust by maintaining confidence in financial reporting and the auditing profession. In a world of ever-evolving regulations and expectations, standards serve as the bedrock of trust and reliability in the auditing realm. Word count: 82. In the dynamic world of auditing, standards on auditing are the guiding stars that illuminate every phase of the audit journey. From initial planning to final reporting, auditors meticulously apply these standards to ensure precision and uphold professional integrity. Each step, from risk assessment to evidence collection, is intricately woven into the fabric of these standards. This systematic adherence guarantees that no crucial detail is overlooked and that all work aligns with the highest professional benchmarks. So, how do auditors bring these standards on auditing to life in practice? By assessing risks, evaluating against criteria, confirming requirements, preparing reports meticulously, and gathering the right audit evidence. This disciplined approach not only streamlines the audit process but also fortifies the credibility and reliability of the final audit report. In essence, standards on auditing serve as the compass that steers auditors through the intricate terrain of audits, ensuring a consistent and rigorous approach at every turn. Ever wonder what it takes to uphold auditing standards with precision and integrity? The key lies in three crucial categories. First, the general standards demand auditors possess technical prowess, independence, and unwavering professional care. Moving on to field work, proper planning, internal control comprehension, and solid evidence are paramount. And in reporting, adherence to accounting principles, consistent application, thorough disclosures, and a clear opinion all play a vital role. These standards are the guiding pillars that lead auditors through the intricate maze of audit engagements. Independence is the cornerstone of auditing. An auditor must be objective in fact and appearance, truly unbiased and seen as such. Without independence, an audit opinion holds no value. Stakeholders rely on auditors for impartial financial assessments, free from conflicts or influences. Independence is non-negotiable in maintaining trust and credibility in the audit process. It's the bedrock that upholds the integrity of financial reporting. Independence in the audit world comes in two crucial forms. Independence in fact means auditors must truly embody objectivity, free from bias in their work and conclusions. On the other hand, independence in appearance requires steering clear of situations that could cast doubt on their impartiality. Even if you are confident in your independence, external perceptions matter. Both types are vital. Auditors must not only be independent but also project an appearance of independence to uphold public trust in the audit process. Takeaway: maintaining both actual and perceived independence is key in ensuring the credibility of audit work. Ever felt the tug of conflicting interests in your decision-making? When it comes to independence in auditing, watch out for these common threats. The self-interest threat, where personal gain clouds professional judgment, like owning stock in a client company. Next, the self-review threat, auditing work your firm previously prepared, risking bias. Then, the advocacy threat, advocating for a client to the detriment of objectivity. Familiarity threat, when closeness to client personnel blurs boundaries. And don't forget the intimidation threat, pressure hindering impartiality, such as client threats. Stay vigilant against these pitfalls to uphold the integrity of your auditing practice. In the real world of independence scenarios, accountants face critical prohibitions. Sarah must divest her 100 shares in ABC Corp to audit them. Michael's firm can't audit XYZ company with his wife as CFO. Jennifer's firm faces a 1-year cooling-off period after she becomes a client's CEO. However, providing tax advisory services to an audit client is allowed with strict safeguards. Ensure management makes decisions and avoids audit involvement. Uphold independence to maintain trust and integrity in financial reporting. Are long-term auditor-client relationships a risk to independence? Auditor rotation rules say yes. To combat familiarity threats, changes in the audit team are mandated. In the U.S., the Sarbanes-Oxley Act of 2002 stipulates lead and reviewing partners rotate off after 5 years. While some places go further, requiring full firm rotation, the U.S. focuses on fresh perspectives and skepticism. The goal: prevent complacency and maintain independence. Ever wondered about the impact of partner versus firm rotation in auditing practices? In the U.S., public companies mandate the rotation of lead audit and quality review partners every 5 years to maintain independence. Conversely, some international practices advocate for complete firm rotation every decade, ensuring maximum autonomy but at a higher cost. The ongoing discussion revolves around whether the benefits of firm rotation in enhancing audit quality outweigh the expenses and potential knowledge loss. How can we strike a balance between independence and continuity in auditing processes? In the world of auditing, rotation timelines are crucial for maintaining objectivity and fresh perspectives. Imagine partner A leading the audit for TechCorp Incorporated for the first 5 years, ensuring a thorough understanding of the company's intricacies. However, by year 6, it's time for partner A to rotate off, making way for partner B to step in as the new lead audit partner. Partner B then takes the reins for the next 5 years, ensuring continuity while keeping partner A at arm's length from TechCorp. After a 5-year cooling-off period, partner A is welcome to return, having gained new insights and perspectives. This rotation strategy not only fosters fresh viewpoints but also allows firms to retain valuable client relationships and institutional knowledge through other team members. By implementing these rotation practices, firms strike a balance between innovation and continuity, ultimately enhancing the quality of their audit services. Auditors are entrusted with safeguarding a treasure trove of confidential client information, ranging from financial data to trade secrets. The ethical imperative of confidentiality demands that auditors shield this sensitive data from unauthorized eyes, both during and after the audit engagement. Breaching this trust can lead to dire consequences, including legal ramifications, professional license revocation, and lasting damage to one's reputation. Nonetheless, there exist specific circumstances where disclosure is mandated or allowed by law or professional codes. This duty of confidentiality is a cornerstone of ethical auditing practices, requiring unwavering commitment and vigilance. Confidentiality in the business world is paramount, distinguishing between what must be safeguarded and what can be disclosed. For instance, it's crucial to maintain confidentiality when engaging in general business discussions or sharing information with family and friends. However, certain situations may necessitate breaking confidentiality, such as responding to court orders or subpoenas, professional practice reviews, or regulatory inquiries. The key principle is clear: err on the side of maintaining confidentiality unless there is a legal mandate or explicit client consent. Remember, the foundation of the auditor-client relationship lies in safeguarding client information, fostering trust, and upholding professional integrity. In the world of auditing, professional judgment is the key that unlocks the door to informed decision-making. It's the blend of expertise, experience, and training that guides auditors beyond mere checklist ticking. Every step in the process demands thoughtful analysis. Is the evidence sufficient? Does the accounting treatment align with standards? How significant is the misstatement? These questions defy one-size-fits-all solutions and call for nuanced consideration. Good judgment, rooted in standards and practice, goes beyond strict rules. It thrives on context, skepticism, and a commitment to the public good. In auditing, decisions often fall between rules-based and judgment-based approaches. Rules-based decisions offer clear guidance with little interpretation, like partner rotation after 5 years. On the other hand, judgment-based decisions require evaluating specific circumstances, such as determining if a misstatement is material. However, most decisions exist on a spectrum, blending aspects of both approaches. Even rules-based standards can demand judgment, while judgment-based decisions must align with professional frameworks. Balancing these approaches is crucial for effective auditing practice. In the realm of professional judgment, a structured framework is key. Deciding and documenting your choices, considering alternatives, gathering vital information, and pinpointing the core issue are all crucial steps. This methodical process empowers auditors to make informed decisions based on facts and standards. The essence lies in being meticulous, impartial, and ready to justify your conclusions. Remember, always articulate your reasoning. If you can't explain a decision, you may need to rethink your approach. So, are you ready to delve into the intricacies of professional judgment? Let's embark on this journey of thoughtful analysis and strategic decision-making. In the world of auditing, standards are the guiding light, ensuring consistent and high-quality work that safeguards both auditors and the public. Independence is not just important, it's non-negotiable. Auditors must remain impartial in appearance and in truth, steering clear of any influences that could cloud their objectivity. Partner rotation breathes new life into audits, guarding against familiarity and upholding rigor. Above all, professional judgment reigns supreme, setting exceptional auditors apart with a blend of expertise and ethical grounding. Remember, in auditing, confidentiality is key and trust is built on the bedrock of safeguarding client information. Ethics are put to the test in real-life scenarios. Can you navigate the complexities? When family and professional duties collide, where do your loyalties lie? Confidentiality breaches loom when personal ties intersect with professional secrets. How do you balance trust and transparency? In the face of financial discrepancies, how do you determine the tipping point between material and immaterial? And when tokens of appreciation blur lines of independence, where do you draw the line? Ethics demand clarity in the gray. Discuss, decide, and uphold integrity always.